What if I told you that every October, a simple holiday, one most of us don't think twice about, actually reveals a dangerous crack at the very heart of our financial system? Today, we're going to dive into what's called the holiday paradox. It's this really strange quirk that puts billions of dollars at risk while most people are just enjoying a day off.
So let's just start with what feels like a super simple question. Is Columbus Day a holiday? Well, in the world of finance, the answer is complicated. And frankly, it's dangerously complicated because depending on who you ask, it's either a day off or it's business as usual. And that disconnect, that's what creates this huge hidden risk in the system. And right here, this is the core of the problem. On Columbus Day, the banks are completely shut down. They're following the federal holiday schedule. But the stock market? Oh, it's wide open for business. So you have these two critical, interconnected parts of the same financial system operating on two totally different schedules. And that's exactly where the trouble begins.
This split creates what we can call the holiday paradox, a market that is literally divided against itself. And to really understand why this matters so much, we need to take a closer look at who's open, who's closed, and most importantly, why. Okay, check this out, because this table is where things get really interesting. The banks and the Federal Reserve, they're closed. Federal holiday, makes sense. The stock market, which is a private company, decides, hey, we're going to stay open. But look at that third line. The bond market is also closed. Now, I want you to just keep that little detail in your back pocket because, trust me, it is the key to this whole mystery. So you might be thinking, okay, why does a bank closure matter so much? Well, it's not just that your local branch has its doors locked. It means the entire financial plumbing of the country, the whole system run by the Federal Reserve, just grinds to a complete halt. Money can't move through wires, financial settlements are frozen, and all that cash that keeps the markets running smoothly, what we call liquidity, it basically dries up for the day. Which, of course, leads us to the central, multi-billion-dollar question here. If the entire system for actually moving money is turned off, why on earth is the place where people buy and sell billions of dollars in stocks still running at full speed? It seems incredibly risky. And you'd be right. It is absolutely risky. This situation creates something called the low volume trap. And honestly, the best way to picture it is to imagine holding a high-speed car race on a sheet of pure ice. This quote from our source material just nails it perfectly. The cars are fast, the engines are roaring, but there's absolutely no grip. The slightest little twitch of the wheel could send everything spinning wildly out of control. So let's break down what that actually means in market terms. So what the pros call this is low volume risk. With all the big institutional traders from the banks out for the holiday, there are way fewer buyers and sellers than normal. This makes the market incredibly thin, really fragile. A small trade that would normally just be a blip on the radar can suddenly cause a massive, totally unpredictable price swing. You can almost see the dominoes start to fall here. First, the key traders are gone. That causes the market depth, the pool of buyers and sellers, to shrink dramatically. Then, because of that, even tiny little trades can cause these huge swings in price. And finally, the whole system becomes dangerously unstable. This right here, this is the exact environment where you get a flash crash, a sudden chaotic market collapse that could hammer everything from huge investment funds all the way down to your personal 401k. You'd think so, wouldn't you? If everyone knows it's like racing on ice, shouldn't there be some kind of giant flashing warning sign? Well, there is. It's not written down anywhere. It's hidden in plain sight, in the actions of that one market we haven't really talked about yet. And that brings us to the most telling piece of this whole puzzle. The bond market. Remember how it was also closed? Yeah, that is not a coincidence. It's the canary in the coal mine. It's the silent alarm that proves the insiders know exactly how risky this day really is. No, seriously, this one fact is the whole story. The fact that the market for U.S. government debt, which is supposed to be the safest asset on planet Earth, is shut down, that tells you everything you need to know about how stable the system is on this day. And this is really the gut punch. The source material calls the bond market's closure a de facto admission of the systemic risk. In other words, by just refusing to open, the bond market is quietly admitting that the financial plumbing is just too fragile to handle any trading when the Federal Reserve is offline. So why does this one detail matter so much? Because it's a deliberate choice. It's an active move to reduce risk.
The people who run the bond market are consciously protecting their assets, the ones most vulnerable to problems when the money can't actually move. It's a clear signal from inside the system that running the market on a bank holiday is fundamentally unstable.
So, what's the final verdict here? What does this strange holiday paradox actually teach all of us? Well, it's a really powerful real-world lesson in a concept we call systemic risk. Let's just put a name on it: a systemic disconnect. This is exactly what happens when different parts of a complex, interconnected machine, like our financial system, fall out of sync. You've got the stock market acting like the engine, but the banks, the fuel lines, are clamped shut. When one runs without the other, you create this massive hidden vulnerability. This one, seemingly minor holiday disagreement, actually reveals a really profound truth. Our financial infrastructure is not one seamless machine. It's a collection of different parts with different rules, and they don't always work together the way they're supposed to. And that's really the ultimate takeaway here. The biggest dangers aren't always in the middle of a loud, screaming crisis. Sometimes they're hiding in the quiet moments, in the gaps between the systems, on a simple holiday that most of us just see as a nice day off. And all of this leaves us with one final and pretty crucial question. If a simple disagreement over a calendar date can create this much hidden risk, what other hidden disconnects are just built into the architecture of our financial system, quietly waiting for the right moment to surface?